Hey traders, Todd Gordon here with TradingAnalysis.com. This is for CNBC's Trading Nation. Traders, we are going to take a look at a setup in Netflix today. Netflix is post-earnings. The volatility has come out. The stock looks extremely strong, and I want to move in on the long side. So to start, you can see that following the earnings, the volatility or implied volatility has come out because obviously earnings being such an uncertain event is going to pump up the price of options. After that event is out of the way, you get what you call the implied volatility crush, or the IV crush, and that's that yellow line moving down to the bottom. That means options, both puts and calls, are relatively cheap. So now is a good time to move into the market if you have a bias on the underlying direction. The next point I want to make with you here is the triple top that's going on here in Netflix. You can see we've tried to break through this $130 region 3 times over the last 2 years, and it looks like if the broader market can stabilize, Netflix might finally get that push through 130. So I like the setup here in the daily. Let's move down to the intraday chart, and there's a nice little pattern that we technical traders like to use to trigger us into entries. So let's get down to the 60-minute chart, and in fact this guy's already starting to move here. So we have a nice little consolidation here following the nice gap up in the earnings. So it looks like we've got a move on this trade to take us up through the $130 mark. So what I want to do is let's just go over to the Netflix option chain. I want to go out, let's go out 22 days. Let's go out to those November monthlies. We're trading 128. Let's go ahead and buy a call spread out of the market that will give us a positive reward to risk ratio. So let's go ahead and buy the $130 calls. Let's pair that up with sale of the $135 calls. Altogether, that's going to be a $1.71 option premium we're going to put out there, which is your fixed and limited risk. It's $171 per option spread you're trading, which gives you a potential reward of $322. So a nice positive reward to risk ratio. So let's put this trade to work. No, I don't want to pay that. The mid price is $1.62. You got to watch that. The bid is $1.51, which means the market makers are willing to buy there, which means if you want to sell, you have to sell at 151. If you want to buy, right now you have to pay $1.76. But options trading is always negotiable. So let's go in the middle and see if we can get a deal on this spread. So I'm going to go in at $1.58, and I'm going to let that order work. The other position that I want to take care of here is we did a Google earnings trade. Google came out, had strong earnings, and the position is acting quite well. So let's go ahead and book profits there. Back on October 27th, we sold the Google put spread, which is a bullish position going into earnings. The spread is now worth about 10 cents, so we're pretty close to max profits there. So let's go ahead and close that position out. Right now, they're giving us a 10-cent offer, so let's go ahead and close that position out, book profits, and we're good to go there. All right, guys, so that is the trade in Netflix, also booking profits in Google. For CNBC's Trading Nation, I'm Todd Gordon. Good luck on that trade, and we'll see you on the next video update.
Hey CNBC fans, thanks for checking out our YouTube channel. Here you're going to find videos packed with all of the information that you need to be smarter about your finances. You can subscribe by clicking right here and click on all the videos around me or the eye right here to watch the latest from CNBC. Thanks for watching.